You could be wiser as an educated advisor. Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, tax consequences for seniors, part 2 of our series on cash value life insurance and tax-free income. All here on Let's Get Down to Business. Okay, now I want to welcome you into a tax correlated system. When you think about the United States tax code, is the most convoluted tax system and revenue system I've ever seen. You take your marginal tax bracket, which is progressive, right? And you have to play with all the possible ensnarements that are built into our code. It's really there as an entrapment issue. Nothing's for free. I remember when they installed the alternative minimum tax, that was a huge issue because people were learning how to game the system, and they brought the AMT, or the alternative minimum tax, into play so that people could not go ahead and kind of skirt taxation. Now, the first thing I want to talk about is the tax correlation of the system. Once you understand this, you see how important it is to have good planning. You need to have an enrolled agent of the IRS that knows what he's doing, or a CPA, a good tax accountant, an attorney tax accountant. People that know their stuff understand how correlated this is, and they're able to stealthily and artfully craft a tax management strategy for you so that you don't pay any more taxes than you need to pay. When you're in retirement, every dime really matters. And so when I'm looking at retirement taxation management, I think I can usually free up 10 to 15% if you'll let your professional tax consultant manage your taxation. That's good money, and that money is not at risk in the market. That's just really using your tax code artfully for your retirement system. Believe you me, you could free up 10 to 15%. Now, when I'm looking at tax, I'm so surprised that this is still true in America. Qualified plans are taxed at ordinary income tax rates. There is no basis. There's no return of principal. So when we're looking at qualified plans, you remember it's all taxable, and all of the taxable qualified event flows over to the Social Security form, and it is counted as income. And so you could actually start paying taxes on your Social Security benefits because of qualified plan monies. So it's very important to think through what I'm doing with my qualified plan. Should I take it out at the same time? Should I delay it instead of taking it out at 59.5? Should I delay it at 62 when maybe I might take Social Security? Should I delay it till full retirement age 66 at full retirement for most boomers? Or should I push it all the way out to 70 and just worry about required minimum distributions? Regardless, I'm paying taxes on my qualified plan. There is no basis, and it flows over to the provisional income test for Social Security, and that counts as income, and your benefits can get taxed just on that basis. Now, remember, I said earlier, if you were going to use cash value life insurance, you have to make sure the policy stays in force. If that policy, for whatever reason, ever was not in force, or it defaulted or terminated while the policy insured is alive, you'd have a phantom income tax on all the policy loans that were collateralized, all the gain. And since most clients don't pay the annual interest, they're letting the cash values cannibalize themselves, but to pay that annual interest, you're going to have a phantom income tax, and that phantom income tax is going to be converted into ordinary income in the year that that event occurs. So it's really huge, a very significant issue as a watchdog issue to make sure that we keep that policy in force for the life of the policy insured, or you'll incur phantom income tax, which will convert to ordinary income tax, and then you'll be in Social Security will then be injured and damaged by it because you'll have to pay Tier 1 or Tier 2 taxation. I want to also talk about one other issue here, capital gains. Many times seniors say, Steve, I'm really doing well here. I'm only paying capital gains on my funds. It's really a good strategy, and I do the same thing. I think it's great. But just keep in mind that you need to know what your AGI and your MAGI, your adjusted gross income and your modified adjusted gross income, before you make pronouncements on that you're at the lowest capital gain treatment. I had a client that called me and sold a significant piece of their mutual fund portfolio. It was a good time. It was time to take some money. It was a great run, and they wanted to take money off the table. No problem with that. And he thought that he would be maybe in the 20% tax bracket. So I said, well, if you'll send me over your 1040, I'll have one of our tax consultants look at this, and he'll tell you exactly what you're going to pay. But he did not realize that the numbers that he was actually earning, he was well over the $250,000 modified adjusted gross. He did not realize that he was subject to the Obamacare capital gain surcharge. So he was not only paying 20% capital gains, but he was paying 23.8 8% because of the 3.8% Obama surcharge on capital gain treatment. The only reason I bring this up is because people are usually shocked and staggered that the Obamacare, the actual health care, has something to do with investment. And so it's really, I want to bring you up to speed. But remember, it's not only you're paying all the money that you're paying, you're not paying just 23.8. That money's flowing over to your Social Security, and you're going to wind up on your provisional income test, and it's going to be taxed. Not the tax that you paid, capital gain, but the entire amount of the gain. So you're not only paying this gentleman was paying 23.8 in capital gain treatment, but all the gain of his mutual fund sell-off flowed over to his Social Security, and it bumped him into Tier 2. So he caused inadvertently a ordinary income tax event on his Social Security. I'm sure that was not his intention. So it's very, very important for us to keep up to speed on what we're talking about here on tax management. That's why I like to give it to our enrolled agents of the IRS, an attorney that's a tax consultant or a CPA. Help us manage this. And it's really great this is a good way to get in with the fiduciary market and actually start expanding your partnerships. Another thing I want to talk about is the alternative minimum tax. I had a client years ago that actually sent me a portfolio after hearing us on a show, and he said, I want you to tell me what do you think, Steve? And I called him back and I said, I noticed you have an extraordinary amount in your portfolio to municipal bonds. And he goes, that's right. I said, and why did you buy those municipal bonds? And he said, I bought those municipal bonds because I didn't want to pay tax. I said, well, sir, would you send me your 1040 just to make sure that you're not paying any tax on these muni bonds, because you have such a huge, I think his total portfolio was almost like 1.4 million, and $500,000 of it was in municipal bonds. He sent me his 1040. I went to the second page. I think it was line 36, and he was paying the alternative minimum tax. Some of the municipal bonds were under a preference item, and because those municipal bonds were under a preference item, about 100K of his $500,000 holdings were actually subject to the alternative minimum tax. And because of that, he was paying alternative minimum tax on a municipal bond portfolio that he thought was tax-free. But that wasn't the worst. I had to go one step further and say, and all your municipal bond income is flowing over to your Social Security provisional income test, and all of it's includable to find out if your Social Security is going to get taxed. And in his case, it shot him right to Tier 2. He's paying the highest exposed tax for Social Security. So remember, as I said earlier, everything is tax correlated. So I can't just do what we want. We have to do it in proper timing and to surrender or terminate or sell off positions that will have tax sense to it. And another area, when you're thinking about putting all this together, you're looking at the final Social Security itself. And that's why I like to say, I try to think about, if I'm planning for Social Security, I want to start planning my exemptions. I want to start planning my deductions. I want to start planning maybe tax credits. I want to start using it stealthily to offset Social Security if I can, to try to bring it down to zero. It's possible. But sometimes when I have these other product lines and these other taxation, it's going to flow over. So defending your actual rate of return or your pocket money, your cash flow, is a huge issue. And I say, next to figuring out how to pay for retirement and funding it, the next thing is to make sure I don't pay any more taxes than I have to pay. So I'm always coordinating qualified plans, any non-qualified capital gains, any non-qualified ordinary income tax, or AMT, and trying to move it around and trying to make my income and take constructive receipt of monies at certain times to benefit one thing and one thing only, and that is paying taxes. And don't forget to watch our next segment on the Tax Bracket Racket, part 3 of our series on cash value life insurance and tax-free income. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your compliance officer. And don't forget, you can subscribe to my consumer show, Steve Savant's Money, the name of the game, daily content that you can post on your website, social media accounts, and database distribution. I'm Steve Savant. Thanks for watching.